All right. Good morning. Good morning, everybody. So we've got a really busy week. We're going to get rate decisions from around the world, including some important ones like Japan. It's going to directly affect the carry trade, which I was looking at that this morning, or a proxy, and it fell down into the halfback from Friday. So kind of want to keep our eye on this. If that breaks, we're likely to see the ES retest some lower levels, 5611, 5600, 5592, and then beyond that, 5550, which would put us back down into last week's kind of Wednesday level. So we'll see. It's worth keeping an eye on. Otherwise, it's hurry up and wait. There's a lot of anxiety about the situation. The Fed generally does a better job of telegraphing the expectations, right? What they're going to do. And so there was a lot of discussion over the weekend about how uncertain everything is on whether or not we'll get, a 25 basis point cut or a 50. Most analysts say that a 25 basis point cut at this point would still leave us in restrictive territory, which means that they're still going to be behind the curve. And I'm sure by now you guys have caught my mantra: the Fed is always late. Always. Always. If there's ever a time in history that you can go back to, which I think was maybe in the 90s, and you can point to where they weren't late, they were ahead of the curve, it was an accident, right? They stumbled onto it without intending to. So otherwise, they're always late. Just put it in your pocket. Assume that if they're cutting, they're already behind the curve. The damage is done, and the steamroller just hasn't finished rolling the wheel yet. They're always, always late. A couple of people I know like that, right? They're just habitually late, right? I'm sure we all know those kind of people. They're never on time, ever. That's the Fed, right? So just kind of own it and accept it. So if they don't cut 50, they're going to be behind the curve. But if they do cut 50, it's going to signal that they're trying to chase, right? And perceptions matter, and they don't want to put out that impression that they're trying to rush or to chase to get caught up. And so we're in this pickle where they want to save face and make it look good and not spook the market, so they won't do a 50. But on the other side of that, if they don't do a 50, then they're behind the curve. They are late, and they're going to be chasing it. Add to that it's an election year, and there's not very many times in history where the Fed has started messing with rates in an election cycle. I mean, it happens because, they got to do what they got to do, but they really try not to. We're seeing a continuation from small caps last week. It's a nice little bellwether for a continuation. I mentioned Friday that everywhere you look online right now, all the news, all the media, everybody's pointing to the doom and gloom and mentioning that the Fed is behind the curve. They're too late. We're going into a recession, hard landing, blah, 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 blah. Well, we just keep holding the line and grinding higher. And that was my point Friday in the morning briefing: is what if they're wrong and we just keep on grinding? Because so far, that's what we keep doing. We keep holding the line and just grinding higher. So sure, everybody's got the same data. We're all trying to parse it out as much as we can. These small caps coming back to life is a good signal. Friday, we've still got it today. Keep your eye on it. Be interesting if we can start to see like a short covering rally, which we've had some good beaten down names coming back to life and forgotten sectors uh, being found again. So it's a part of that breadth structure, right? We want to see more than just the Mag 7, the popular 10, whatever you want to name them. We need more than that. So if we're seeing small caps come to life, an area that hasn't gotten a lot of love lately, keep your eye on it. It's a bit of a tell. So busy week. There's some rumble about the retail sales tomorrow and how it may directly impact the Fed's decision. I don't think so. But what it very likely will do is impact the way the market thinks the Fed is going to decide, right? So this isn't, the numbers from retail sales isn't going to change what the Fed is about to do, but it will change how market participants imagine the Fed is going to behave. So we'll see how the market likes those numbers tomorrow. That makes those numbers the most important thing between now and FOMC, Wednesday at 2 o'clock. It's kind of a big deal. Yeah. What a week. We've got additional auctions today. We're going to continue to get data out of Europe, Japan, US. It's just going to be a busy week. I would not expect a nice, clean trading week. I think it's going to be choppy, violent. We typically expect to hold the line into FOMC, kind of go sideways in a range. But if you go back and look what we have been getting in the last few years when it comes to FOMC, is we've seen a lot of weeks with a really big move on Monday and then a reasonably decent move on Tuesday before Tuesday afternoon, and then we start to base and go sideways and wait on Wednesday. That we aren't seeing 2.5 days of sideways. So it's certainly possible. Just don't hang your hat on it because I think we could run. I don't really have a direction per se, but the idea that we're just going to range sideways into FOMC, it's not sitting very well with me this morning. And I think a lot of it has to do with the market's indecision or lack of clarity on what the Fed is going to do. As I mentioned last week, we're very likely going to see a market maker move every single day this week. And it's not because they're hedging, it's because they're rolling out of the contracts that are getting ready to expire, right? So that's really going to mess with things. You should already be on the December contracts. If you need to manually roll, this would be a good time to do it. Generally speaking, you want to think about rolling when the next expiration out has more volume than the current expiration. Now we can see that this morning that the December contracts are not as high yet, but they're pretty darn close. Some people just automatically in the last week, they just go ahead and roll. This isn't right or wrong, good or bad. At this point, they both have nearly identical volume. But through the day today and certainly into tomorrow, you're going to want to reconsider staying in that September and just go ahead and moving into the December contracts. Thinkorswim and TradingView both auto update. As far as I know, I don't think you can. I don't think you can stop that from happening. Maybe you can. On TradingView, I'm sure you can, but on Thinkorswim, it just does it. All right. So we're going to see this market maker move happen a lot this week, and that makes the indicator worthless this week. They're going to hedge. We know that they are, but we won't be able to distinguish that hedging from the rolling. So it's just the way it is, right? No indicator's perfect. There's times where, where they just are not effective, and that happens to be right now. You can see, however, that we're in a really low volume environment as well. So, that would tie in with, oh, they're hedging. And, the sad thing is maybe they are hedging, but we would never know because we can't distinguish it. The best we could do is try to come in here and spot some of that trading activity. Maybe find some activity that's in some way indicative of a hedging behavior, but be a lot of work to still end up with a maybe. Otherwise, we're above all the major moving averages, 10, 20, both the day and the week, 3-week, everything. We're basically flat this morning, so we're holding between the ADR lines. I would be surprised if we even touch one of those ADR lines. That would be 57.20 down to 56.50, basically. There is a discrepancy between the old one and the new one. It's about 50 points, right? That drag is also going to affect the way the SPX behaves. So it's going to be a fun ride, that's for sure. Take the halfback of yesterday within the RTH, just the RTH alone, and you get 56.80 for the halfback. Now, if you want to catch everything, then it's 56.75, which gives us a reasonably decent zone here. Kind of a line in the sand that needs to hold. Imagine that. It's right where the central pivot is. So the central pivot this morning, it's higher than Friday's level. It's completely outside of the range. They're not overlapping or touching. And the channel this morning is smaller than Friday's channel. It's not as small as we would like it to be, but a smaller channel implies that if we do break out, we could run. We don't have the AM founders note yet, but the last gamma report that I saw had us basically flat, and we would want to see a negative gamma for another indication of if we break out, we run. I'm just looking back at Friday's founders notes in the PM, and it was at a positive 1.2, which implies a breakout likely fails. So we'll see. We are quite a distance already from the weekly pivot. This isn't overbought or any kind of thing like that, not yet. But how far away we get from the weekly pivot does matter. And the fact that we're already this far away limits how far we would expect the market to be able to move before we do start using that phrase overbought. We get too far away. Last August, we made a 6% move away from that floor pivot. So, when I say overbought, I mean, we'd have to really travel, right? 6% is a pretty darn good move. And we're nowhere near that at this point. So sure, we're opening above that, but not even 3%. So it's fine. We've been talking about this volume profile on the weekly for a while around this 5,700 area. We can see these overlapping points of control back here. And we're up into that level, into that area now. 5692, it's a cog line, 5,700 round number, points of control there. History against this structure at these highs, 5711. It's going to be really difficult to get through this zone. Even just getting there and getting above it isn't enough. We've got to leave that zone and then come back to it from the top side to validate it as a new support level. Otherwise, it's much like how it was back here. We were just crisscrossing back and forth through it, and it wasn't acting as a support or a resistance. We need to leave the range and then come back to it and see if it's going to act supportive or resistive. Ten-day, 30-minute volume profile. This is a really ugly profile. There's nothing here but the point of control a long ways down, and we're not expecting that to move. But it is possible if we do stay here at this 5692 area and we wait on FOMC, it is possible that we move this point of control up here. But we'd have to stay here and really build it out, right? We can't continue to expand. Any break back below 5650, get us out of this larger structure here. Any break of that should get us back down into 5600 and then back down into this lower point of control 5578 area. This is a really nice cup. Even the fact that we didn't get all the way back up to this previous high is not a negative. It's still seen as a bullish positive sign. It's a lot of cups that form that way, right? Miss getting into the top. Then you get like what Grimes talks about, this pre-consolidation, pre-breakout consolidation. So if this is a really big cup, we could get a handle, a move back towards this point of control, catch some structure around 5632 cog line, and then a move to the upside. It doesn't have to give us a handle, by the way. Cups can form without a handle, still be bullish. We don't have a new VPOC from Friday since when we opened last night. We dropped down, cut through this level to the upside, and then the downside, we've hit this point of control already. So it's not a VPOC. Having said that, the textbooks will tell you, use yesterday's profile, carry all the lines forward into today. I've already got enough pivots. I don't need another one, but it doesn't mean that they don't have value. You see the shift has kind of messed up our drawings. It's likely going to take the broker a few days after to kind of get everything settled. The spread differential is just going to mess with everything for a little bit. All right, so last week we measured the range for the upcoming week. It wasn't set in stone at the time, but it was giving us an idea of what the projections were looking like. But now we do have the range, and it's less than last week's. Now, how wide this range is based on time and volatility. Well, we have the same amount of time this week as we did last week, so that's not different. The only other thing that's different then, which would make it smaller, is that volatility is lower. I know it doesn't seem to make sense. It's an FOMC week, but somebody smarter than me once said that FOMC is volatility suppressing. Man, I disagreed with that statement the first time I heard it. Have you seen what happens on FOMC? Big moves all over, up, down, all over the place. But the phrase is still true. As we get closer to FOMC, the market starts to sit on its hands and waits. And that waiting is that lack of movement. And that lack of movement is lower volatility. So yeah, FOMC and other events are volatility suppressing until they get here, right? And then they're big violent moves of volatility. So it makes sense that next week or that this week has a lower volatility range because we're expecting a market to go sideways while we wait on FOMC. But as I showed last week, here's an FOMC week. Monday, we made a decent move. Tuesday, we continued that move. Wednesday, we continued it even more. They weren't big blowout moves, but it was still a move, decent size. Same thing. Here's another FOMC week. Monday was pretty much staying inside of Friday's range. Tuesday stayed inside of Monday. You could argue on that one. Really nice IX10 range. That was a wait on FOMC for sure. Another one. Monday managed to break out of Friday's range. We really didn't go too far. Tuesday continued the breakout, basically doubled what Monday did. And then Wednesday, FOMC broke outside of the box and continued the move to the upside. So we can move on FOMC. And unfortunately, those were all positive ones. Don't think that it's always going to be a positive outcome, right? We've got an FOMC here, even though the whole week isn't showing. But Monday and Tuesday were both red days before the FOMC. So it doesn't have to be all positive either. We are 1% above the 10-day moving average, which is getting close to the sweet spot. Usually around 1.5 is where we kind of want to be. It's 1.5% above the 10-day moving average. We're not quite there, but we're looking pretty good. This is not overbought. It's not overextended. We're not looking for any sort of mean reversion or least squared method, anything like that. We're sitting exactly where we would want to be. We're 2.35% above the 10-week. That's also a little short of where we would want to be. 2.5, 3.0, those are good. But this isn't bad. It's not negative in any way. It's fine, especially on the idea that it's still growing. You know, it's not like we're on the decline. That would be a different discussion. So we came back up through the 10. We've continued to expand to the upside. Everything looks fine. We're not overbought. We're not overextended. Technology is up more than 6% over the last 5 days. Consumer discretionary is up 4% over the last 5 days. When it comes to a risk-on market behavior, being bullish in the S&P and the NASDAQ, these three across the top are what you want to see. We only need one, maybe two. So if we're getting 2 out of 3, it's still a bullish market backdrop. The financials are the ones that are really suffering, and they're not suffering enough to stop these two from doing their job. These sector ETFs are not supposed to be big movers, right? They're supposed to have a low market move, small ADR, small daily ranges, not making 6% moves in 5 days and 4% moves in 5 days. So just another indication of volatility that's out there. These are violent moves. I would look for, violent reversals when they come. Don't try to catch a falling knife on these and anticipate where the turn is going to be per se. But once they do start to turn, I think we're going to feel it. A lot of these other sectors, 2.5%, 2% in utilities, building materials, industrials, the forgotten names, right? The everything else market. There's been a disagreement or an argument that's been going on in the market over the last 4 months on if the Mag 7 call timeout and quit carrying us for a year or so, will the rest of the market step up and finally get caught up, or will everything fall? And looking at this, we're seeing a lot of the other markets step up. Keep your eye on financials, though. They are a bellwether. So you got the proxy trade, the financials, always the Mag 7, right? The NY FANG, you can just look at that index. I think those are going to be your better indicators today than anything else. We've been seeing big moves in the dollar and the 2-year. So we're just looking to add to that, right? Because right now, those aren't enough. Now, some swag levels, if the dollar gets below triple digits, say below $100, we're likely to see the market begin to respond to that. And say the 2-year below 3.5, I think as a swag level, the market's likely to start responding to that. Plus the carry trade. We break this half. I think we're going to feel it. All right, things that are down this morning, Bitcoin the most. And then semiconductors through the SMH. I mean, sure, they're down 1% this morning, but they were up almost 9% in the last 5 days. So, it was up 9%. It needs a little bit of a pullback. It's down a little this morning. Not a surprise there. The XLK tech was up more than 7%, just round a little bit. So the fact that we're down a little there too, not really much of a surprise. On the other side of it, things that are up this morning. What's that? Biotech and that's it. VIX. Nah, we don't want a rally on biotech. It's like getting a rally on pot stocks. This is the sort of headline that's likely to move us, right? The data we're going to get between now and FOMC isn't going to make the Fed do something different, but it's going to make traders see what the Fed is likely to do as something different. Getting some moves still out of precious metals, but we're still stuck inside of yesterday. A small pop in the China ADRs. It's not their time yet. Building materials and then the VIX. This is a really flat market this morning. It's one thing that just keeps coming up again and again is we really don't have anything happening yet. Semiconductors are down a little bit, but after the move that they had, it makes sense that they're going to pause a little bit, right? So you got SMH tagging the underside of that 50-period moving average. It's about the halfback of this last structure. It makes sense that we're going to pause there, right? Now, whether or not we pause there and then continue to move to the upside, or whether we reverse and come back down. I thought we were at the halfback. We're actually above it. So we've got support underneath this potential support. We don't know if it's going to be support or not. See how it acts at 33.5. It's that halfback level. If it finds structure and support there and continues to move to the upside, if not, we'll measure this last big day, this the 9/11 day. Put the halfback on that, see if that structure holds. But now that it's made it through the half, it's supposed to keep it. So we really don't want it back below that half anyways. So what we've got, guys, a hurry up and wait scenario, watching for data, looking for market reaction, and keep in mind, it's not just the US markets this week, right? Europe, Japan, the US. Keep your eye on that carry trade. Everybody be careful, be